Well, good Monday morning. Welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA, and it's February. So each month in 2021, we are going to be doing a sort of a different theme for the podcast here. And so for February, we're going to focus on commercial real estate. It's one of those sectors of the industry we focus so much here at the California MBA, it seems, on residential issues that we may, sort of leave the commercial folks off to the side a bit at times. So we want to make sure that we focus on their issues and their people, and make sure we get their stories in our podcast as well. So in February, we're going to focus solely on commercial real estate, and we've got some great speakers lined up, and I hope you stick around and listen to us this month. So today, let's jump into the conversation here in just a minute. But before we do that, I want to thank our sponsors over at Accelerate. So if you're looking to close more loans in 2021, in which if you're listening to this podcast, again, that should be everybody, you want to experience Accelerate's award-winning customer engagement platform that features lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing, which includes text, social media, email, direct mail, phone, ringless voicemail, retargeting, and much more. So Accelerate, bottom line, helps lenders close more loans through better borrower engagement. And if you want to schedule your personal demo, make sure and go to accelerate.com and you can check that out. And then on a personal note, I mean, obviously we know Accelerate very well at this point. We've been talking about them on the podcast here for quite a while. If you want to catch them on social media, make sure and check out Josh Friend's profile on LinkedIn. Josh puts out a lot of great content there, and so I highly recommend that everyone follow him on LinkedIn and keep an eye on what he's putting out. There's a lot of great stuff there. So before we jump into the conversation with today's guest, I want to toss it over to Susan Milazzo, our CEO, for this week's weekly update. Susan?
Thanks, Dustin. Hi, this is Susan with the California MBA here with your weekly update. So the legislative session started a few weeks ago here in California, and there is one bill that I'd like to mention today that relates to commercial lending. AB 255 has been introduced. It's just an intent bill right now, so there's not a lot of substantive language quite yet, but it is the intent of the legislature to enact some rent relief provisions for small business owners experiencing loss during the pandemic. We are monitoring this bill to ensure that some of the same problematic provisions that were included in SB 939 from last year, as you might recall, among other things, included a temporary moratorium on commercial property evictions. Just making sure that this monitoring provisions of this bill as they're added to make sure some of that same language isn't included. The legislature has given an indication that they are looking for legislative solutions this year to help small business owners during the pandemic. So it is likely that we will see more measures of this nature. AB 255 will be a bill that we continue to monitor. As I said, more substantive language is added, and it will be part of our legislative priorities in 2021. That's it for this week. Back to you, Dustin.
All right, thanks, Susan. All right, let's get into the conversation. I want to welcome in Gary Bechtel. Gary Bechtel is the CEO at Red Oak Capital. Gary also serves on our board of directors, and he's also going to be the chair of this year's Western States CREF Conference, which is going to be September, let's see, I've got the date here. It's going to be September 8th through the 10th, and it's going to be, actually, we're planning at this point for it to be in person at the Aria Resort and Casino in Las Vegas. So make sure if you're in the commercial sector, make sure mark down September 8th through the 10th. And you can actually register here, and you'll be able to register here in another couple of weeks, it sounds like. But sponsorships are open right now. So if you want to get involved in the conference, you can certainly do that right now, and definitely bookmark that date. So Gary, welcome.
Thank you. Happy to be here. Thanks for the opportunity, Dustin.
Yeah, absolutely. So let's start at the beginning. I know you've got sort of a unique story about how you got into the mortgage industry. So let's tell us about your background, how you got into the industry, and how you wound up at where you are now at Red Oak Capital.
Yeah, sure. So I got in the business in 1986. So I've been in the business. It's my 35th year. So clearly a glutton for punishment. Been through a number of cycles, the good, the bad, and the ugly. I got into it and started out as a mortgage banker. I came from a completely different industry. I was in the marine industry, not the Marines, but I did a lot of competitive yacht racing in my youth. And I was sailing with a lot of guys, back in the day that were in the real estate space, whether they were commercial, residential, development, finance, et cetera. So I saw how successful they were, and I'm like, I can do this. So I got in. My first job was I was a loan originator at the Allison Company, which is a Southern California-based mortgage banker representing a number of life insurance companies. So that's how I started in the business. And over my career, I probably spent equal amounts of time either on the mortgage banking side, either actually originating loans or later in my career, and I got on the lending side, probably, I don't know, 15, 20 years ago at least, and have kind of split my time equally between, originating and running either mortgage banking platforms or lending platforms, which is what I've kind of focused on really the last kind of 15 to 18 years at a few different shops. So, but that's how I got into the business. I got in as a mortgage banker representing life insurance companies. Even back then, probably starting in the 90s, I was involved with CMBA. So, the Western states that you mentioned is near and dear to my heart. I think I've only missed one. So it's always been fun. So it's a pleasure to be on the board of CMBA, California Mortgage Bankers Association, and then this year to be chair of that event because it holds a special place in my heart.
Yeah, it was tough to see that see us go virtual last year. I mean, the event seemed to go pretty well, but I mean, for anyone that's been to that conference, it is such a unique experience to be in person and be able to shake hands and visit people that you maybe only see once or twice a year. So it's definitely something that works better in person than virtual. So we're looking forward to a good event this year.
Yeah, I mean, sorry to interrupt you. I mean, that's why we go to these, right? We go to reconnect with people that we may only see once or twice a year. Maybe we see them at Big MBA, and then we see them at California Mortgage Bankers Association. So, that's the reason to go, is to reconnect for people that we haven't seen, even though we're competing against one another or dealing with one another, depending on what side of the table we're sitting on at that point in time, right? But yeah, it's all about being, and so I'm looking forward to hopefully having an in-person event this year and reconnecting with people that we weren't able to do in 2020.
Absolutely. Well, and it's funny too, you mentioned the getting started with the Allison Company. It's not necessarily a name brand in the mortgage industry these days that you hear about all the time. It's not in the news all the time, but
sure.
It's amazing to me how many folks in the industry on the commercial side can trace their their lineage in the industry back to the Allison Company. It's fascinating to me.
Yeah, you're absolutely correct. I mean, and a lot of those guys are still in the business today. I know, it's a unique fraternity, right? There's a lot of guys that are still in the business at different mortgage banking shops or in lending shops that got their start at the Allison Company, representing Travelers and Manufacturers Life and others. So it was a great training ground. It helped me in my career. I barely knew enough to be dangerous when I got into the business and worked for Allison in an office that they just opened down in San Diego. But you're absolutely correct. There's a lot of guys that trace their careers back to the Allison Company. In fact, David Christensen, who works for us now up in San Francisco, that was his first job, and that's where I met him. And here we are, 35 plus years later, we're both Allison alum. So yeah, there's a lot of guys that can trace their beginnings back to the Allison Company. Great company. And Nick Madigan and Carl Fuller and Jim Deal and those guys still run a great shop.
Yeah, it definitely speaks well for them that there is such a successful, as you put it, an alum group that can trace their lineage back there. So let's fast forward to
sure.
current day here in 2021. What do you see as what's your take on the current state of the market, and what trends do you see sort of dominating this year ahead that we just started?
Well, I mean, clearly COVID dominated 2020, right? And it's had a continuing effect on the business. It's continuing into this year. A lot of that is driven by governmental actions, depending on the state that you're located within. But in California specifically, right? I mean, we've been under lockdown or semi-lockdowns, pretty much since the middle of third week of March, I think it started.
Yeah.
So that's had a pretty dramatic impact on the business overall. As a lot of businesses haven't been able to stay open. A lot of shopping centers or office buildings have been, hospitality especially, have been severely impacted by the effects of COVID. They can't operate their businesses. People aren't traveling to hotels. They can't go to the office or don't want to go to the office. So, COVID continuing to have a lingering effect in the market. And what you've seen, and what you always see. Again, I've probably been through 7 or 8 cycles, during my career. What you always see is a contraction of the traditional lending sources, right? So the life companies, the banks, the CMBS lenders, the credit unions, et cetera, generally will contract. Either they'll exit the market entirely or they'll contract, when there's dislocation, and that's being kind. So whether it's the Great Recession of 08 to 10, whether it's dot-com bust, whether it's long-term, the Russian debt crisis back in the 90s, whatever the event is that causes this dislocation, you generally will see a contraction in the more traditional lenders, either exiting the market entirely or just reducing the loan to values that they'll provide, the people that they will actually provide capital to, et cetera. So now that's good news, bad news, right? So that's bad news for traditional bank borrowers or credit unions or life companies, right? Because they're going to get much more conservative than they already were, and they're generally pretty conservative in nature anyway, especially the life companies. What that does is opens up voids that are filled by non-bank lenders, such as Red Oak Capital, right? So we are a non-bank lender, right? Where we raise capital through the sale of securities in different SEC regulated offerings, and then we deploy that money in bridge loans, 1 to 2 to maybe 3-year loans. And so, as painful as COVID has been, it's actually been good for the non-bank, lending part of the business, because we're able to come in and fill a void that the banks and other traditional lenders have vacated from or cut back on. So for us, and I think this is shared by a lot of the other non-bank lenders that are in the space that that I'm in contact with, as painful as COVID was and continues to be, it's actually been beneficial for our particular space within the market. But that's not going to last forever, right? I'm very hopeful that by the time Western states rolls around, that we've kind of got that behind us, that the economy is on the road to recovery, that vaccinations have kind of kicked in, and people are now willing to open up states, open up businesses, finish their projects, because a lot of states you haven't been able to work on site if you've got a renovation project, et cetera, right? Are traveling again, so the hospitality sector starts to recover. But and so when that happens, as it's always happens, right, the banks will return, the credit unions will return, the life companies will get slightly more aggressive. So it always goes in cycles, right? But, again, in bad times, traditional lenders contract, and non-bank lenders are able to come in and fill the void. And when the market recovers, it flips around.
Yeah. So do you see? I mean,
but I think
when this airs, it'll be about a little less than a week since California started reopening. Do you see that being sort of a harbinger of things to come? I mean, will things really start picking up now? I mean, it's not a full opening, obviously. We're still somewhat locked down, but at least things are starting to ease a little bit. Do you see that having a good impact on the market?
Absolutely. There is so much pent-up demand for people to get out and go to restaurants, go back to shopping. I mean, look, want to interact with other people, generally speaking, and COVID, given the lockdowns and the fear of becoming infected, just walking outside. I mean, I can't tell how many people I've seen by themselves in their car, windows rolled up, mask on, double mask on, right? I mean, there's definitely that. So it's going to take a while to change people's behavior, but I think generally speaking, people really want to get out. And so when you start to see reopenings, whether it's in California or other states, I think the people will get out and want to get back to shopping, want to get back to a quote unquote normal life that we had pre-COVID. And so whether that's back to that or what they call, we'll see. But I think as soon as these lockdowns start to be eased, depending on the degree of which they are eased, you're going to see people really come back, whether it's in the retail space, the hospitality space, the office space, et cetera. So yeah, I'm looking forward to that. Believe me. I mean, I'm a bit of an anomaly, Dustin, in that I still do a fair bit of traveling for work. I'm generally on the road a couple weeks out of each month, so I'm on an airplane in some other city a lot. So for me, it hasn't really changed, my behavior relative to how I do business. And I know, for a lot of people, it's changed it dramatically. Whether they've been unfortunate enough to lose their job or have their businesses impacted. So for me, it hasn't been a big change, but I know it's been a big change for a lot of people. So I'm looking forward to the day that we can get back to a quote unquote normal life again, and get back out and interact with one another. And again, that's why I'm looking forward to Western states, so I can actually, shake somebody's hand and give them a hug and look at them face to face versus on, Zoom calls. I think we're all getting tired of those.
Go, amen to that. So yeah, well, hopefully eventually things open a little bit, but you're going to miss the empty airplanes and having extra seating and all that. You're gonna miss that.
Yeah, it's been pretty amazing, though. I'll tell you, different airlines have handled it differently, and I fly a ton of them, just given where I'm going in the country. So Delta and Southwest, right? They're still not selling center seats, and they don't sell the opposite seat if you're up in first class. United, American, pack them. So it's been interesting. I can't tell you, I've probably seen half a dozen times as I've been on flights, people in full hazmat suits with, face shields and masks and booties and gloves and the whole thing. Okay, everybody's, got their, to me, if you're that freaked out, maybe you shouldn't be flying, but you in a lot of cases you have to fly, right?
Sure.
Maybe I'm just used to it and don't take it as seriously as I should, but yeah, it has been different flying in different parts of the country on these different airlines because they're all treating it a little bit differently.
Yeah. So, let's. I've got a question for you. So, I'm always curious to hear what sort of the C-suite folks think about this. So, what, as you go into this year in particular, what indices, what indicators, what market numbers, what data are you looking at? There's so much out there that you can sort of get, you can get overwhelmed and lost in the data. But what, as the CEO, what are you looking at in particular?
It's kind of, let's just focus on California, right? We really look when we go in to look at an opportunity, it's asset class by asset class and really market, almost sub-market specific. So we'll do a relatively deep dive to see what's going on in that asset class, in that market, the overall asset class, right? What's going on in retail? What's going on with the rental rates and the vacancy rates and the capitalization rates, from a valuation standpoint, a cash flow standpoint. But you also have to look at, again, staying on retail, and we're still looking at retail, by the way, on a select basis and on clearly a more conservative basis than we would have pre-COVID. But what's going on with population growth? What's going on with income growth or lack thereof? What's going on with the makeup of the population as far as, is it renters, is it homeowners, et cetera? So whether it's retail, whether it's office, look, I wouldn't want to be an owner, and it's outside of our size range, so it's not really applicable to us. But a lender on CBD office, right, to lend in there, some of the major markets, given the fact that people aren't coming into the office and probably won't be coming into the office for a while, those are asset classes that are going to be fundamentally changed. I think retail will actually rebound pretty quickly. I think hospitality clearly is going to take a lot longer for a bunch of different reasons. But office is going to be fundamentally changed, right? You're going to have less people coming into the office. You're probably going to have more space per employee, given social distancing, whether it's required or whether it's just, employees want it to feel comfortable to come back to the office workplace. I think that's why there's absolutely a lot of opportunity in the suburban office, because it's closer to where people live. So they could go to an executive suite if they didn't want to work from home, or they could go to a remote office that their company might set up, or mass transit to get to work, right? Which you're going to have to interact with a bunch more people, which again, some people are fine with it, like me, others not so much. So, I think it's just going to be kind of asset class by asset class, market by market, Dustin. And again, I know we do it, and most lenders do. You just have to get very granular and understand what's going on in that asset class, in that market, before you jump in. Because it's easy to lend money, it's not necessarily as easy to get it back.
Yeah. Well, let's get specific then a little bit. What do you see as being the maybe the hottest asset class or product this year?
That's really easy. It's got to be multifamily and industrial. They are clearly the darlings of the lending and probably acquisition community. Industrial really has become the new multifamily. You still have other asset classes that are in favor. Storage, manufactured housing, for example, are still, and I'd love to do more. I think those are still pretty hot. But industrial and multifamily are probably the two top asset classes that I think lenders would prefer to lend upon, and people that are acquiring property probably would want to acquire. Clearly, retail has had its issues and will continue to have its issues. Hospitality is probably going to be a longer road, unfortunately. But yeah, industrial and multifamily, I think, are probably the top two sought after asset classes in today's world.
Okay, and then what about geography? What do you see as being one of the hotter markets?
Within California or just nationwide?
Maybe both. Maybe what hottest you see in California, and then maybe hottest nationwide.
Yeah, so in California, right? I think you've seen the larger markets clearly, because they have the highest populations or the most dense populations. It's probably a better bet to lend on an industrial deal or a multifamily transaction, for example, in LA County or San Francisco, in the denser communities. Now you have to again pick your spots, pick the asset class, and again look at the dynamics of what's going on within the market that asset is located within. But we've seen a lot of great opportunities, outside of California and other states. Texas still is pretty hot, especially cities like Austin and Dallas. Nashville is on fire. The Carolinas, especially Charlotte, are still very, very active. Atlanta and Georgia is pretty good, to name a few. So, they're what I'll call major markets, but they're not a New York City or Los Angeles or San Francisco. They're not, these huge MSAs, top 10 MSAs, but they're got great fundamentals. You've got a lot of population in migration, a lot of them from California, unfortunately, that are moving to, Arizona, Phoenix specifically. They're moving to Texas, typically Austin, that are moving to Tennessee, typically Nashville. Moving to the Carolinas, typically Charlotte, Raleigh, Durham. So, there are some great markets that aren't, top 10, but they've got great market fundamentals in most asset classes, and are attractive to us and other lenders that are looking at that. Look, because of the sizes that some lenders will put out, where they're only $50 or $100 million and greater, they have to go to the CBDs. They have to be in those, and so their opportunities are, because of the size of those markets, there's a lot of opportunities, but you got to get into then the fundamentals of what's going on in office, what's going on in hospitality, et cetera. So I think to a lot of people, there's a lot of opportunities in these quote unquote smaller markets, like in Nashville, like in Austin. And those aren't small markets, by the way, but they're smaller than, Midtown Manhattan or downtown LA.
Yeah, absolutely. So, question for you. I mean, if you read the headlines, particularly on retail spaces, one of the themes of the last year or so has been that retail is taken in the shorts right now, but it's essentially just aggravating or accelerating a trend that was already there pre-pandemic. It seems like you've got a little bit more of a little more positive outlook on the future of retail. Why?
And you're absolutely correct in that retail was already experiencing issues prior to COVID, as was hospitality. And those issues have only been exacerbated by COVID for a bunch of different reasons, the biggest of which is state lockdowns or restrictions that people either couldn't go shopping or they were doing all their shopping online, which, by the way, is what's helped fuel the industrial space, is all the online shopping. But again, I think in certain areas where they weren't as restrictive, you've still had people, being able to go out and shop, being able to go to restaurants, Texas, right? Florida. I was in Florida 3 weeks ago, down in Miami and South Beach. It was wide open. You wouldn't have known anything was going on. Restaurants were full. People were walking down the boardwalks, et cetera. So, I think it's kind of market by market, but I am bullish on retail in the right areas with the right story. I mean, we recently landed last year on an anchored shopping center in Roswell, Georgia. Great story, right? The borrower had owned it for an extended period of time. They had the perfect storm where they had lost tenants during COVID, but they actually re-let the space, and so they needed money for TIs and leasing commissions to get those tenants into the space. but they had a loan maturing. So they were, instead of being able to just roll into a permanent loan, because they were still in lease up, they needed a bridge loan. So it was a great story for us. There was a lot of value creation within the lease up play. So I am relatively bullish on retail in the right circumstances, in the right markets, with the right sponsor, with the right tenancy, right? Would you want to be a mall owner or a mall lender? I wouldn't, right? But if you're talking about neighborhood centers or big strip centers that are quote unquote Amazon proof, I think there's some great opportunities in those centers, especially in markets where you've got, like Roswell, it's a suburb of Atlanta. It's relatively affluent. It was a good story. It was a good sponsor, and it was something that we could get comfortable with and structure through. So those opportunities will present themselves, and we continue to see them and continue to look at them. But yeah, there's certain parts of the retail stack, i.e. malls, right, and outlet centers, that are very problematic for a bunch of different reasons. But I think neighborhood centers and strip centers where, they are quote unquote Amazon proof to a large degree, even the ones that have been impacted by COVID, I think once they open up and they're, the restrictions are lifted, depending on the state that they're located within, they're going to get back, they're going to recover pretty quickly. So again, it's deal by deal, market by market. You just got to do your homework.
Yeah, well, and I think it's good example here of why you should go beyond the headline and get the more realistic, complicated at times view of an issue. Certainly, you make a good point there.
Yeah, I mean, there's plenty of negative news out there, right? I mean, on almost every asset class, but I don't think you can paint a broad brush that retail is bad, hospitality is bad, multifamily is bad. I mean, there are pockets where it does make sense. Would I look at a hospitality deal today? Sure. Low leverage, conservative, for sure. It's got to be a good flag. It's got to be a good sponsor. But again, like retail, there's good opportunities out there that we should be, that we should be looking at, and we are.
Yeah, I think that makes a lot. And as you pointed out, I mean, you've got 50 states that each had their own COVID response, and they've each got their own lockdown, anti-lockdown, opening up strategies. Yeah. And then even within the states, you've got region by region and city by city, county by county, different setups, and that's certainly affected the market, I'm sure.
It's crazy, right? You're absolutely correct. Even in California, I mean, there's been a number of cities that have thumbed their nose at the lockdown restrictions that Newsom put in place. 2 weeks ago, I had a dinner in Costa Mesa, and I figured, because outside dining had been, essentially shut down, right?
Right.
Costa Mesa, right on 17th Street, full inside, full outside. I'm like, wait a minute, right? But what you're having is, and I heard the same thing about Dana Point, for example, is the government's just, they weren't enforcing the lockdowns. They were letting the businesses stay open because they made the decision that we'd rather let the businesses stay open and I guess deal with a potential COVID fallout versus having those businesses go away and losing employment and tax base, et cetera.
Yeah, and then probably still having to deal with the COVID fallout anyway. So speaking of government, from your perspective, do you think that, government actions, I mean, we've got a new administration now, but certainly here in California, it's still the same administration, but do you see in 2021, the government actions or market forces having a bigger impact on, the health of the market this year?
I still think it's going to be government related, right? I still think you're going to have to deal with governmental actions, whether it's on a state level, city level, or federal level. So that's going to have a bigger impact to me on the ability to reopen, the ability to get back to work, whether that's in offices or what have you. So yeah, I mean, I think the short answer is it's going to be more governmental related than it is market, because I think once the governments, whether that's city, state, or federal, allow businesses, allow communities to open up, the people will come back. Now, it's going to take a while to change the behavior of people, because we've been so conditioned, unfortunately, over the last, call it, year, to be afraid, right? And so you're going to have to change people's behaviors. But I think that will come relatively quickly. I mean, I'm an internal optimist. I really am. I mean, it helps me get through the down cycles of this business. But I think once those restrictions are lifted, it's going to return relatively quickly. I think, again, as I said before, I think people want to get out. People want to interact with other people. People want to, go to, the shopping centers and the restaurants and what have you, and interact with other people. I do. I just speaking from me, my personal viewpoint.
Well, we are social animals in the end. I mean, absolutely. Myself, I'm a bit of a introvert, but I've certainly felt it this last year, and so if I'm feeling it, then certainly, the extroverts out there have to be just going crazy.
Well, so let me in that latter category, yeah. But see, I get my fix because I travel so much, and so I do have the ability to interact with people, clearly on a different level, right?
Right.
With masks and social distancing and all the things that we need to do to try to keep ourselves and others around us as safe as possible. But yeah, I'm a people person. I love being around people and having all that interaction that goes on. It kills me not to be able to, shake somebody's hand, or if I know them, give them a hug. Maybe if I don't even know them, I'll give them a hug. Yeah, so I'm looking forward to getting back to quote unquote more normal life.
Well, hey, another good pitch there for Western States CREF in September. Hopefully we get the chance to do all that then.
For sure.
So, switching gears here a bit, as someone who's, built and helped build several successful companies in the industry, what advice would you have for someone that's jumping in the market?
Jumping into the market to get into this business, or jumping into the market to open or expand a business in today's environment?
Yeah, I mean, either one. I'll let you take your pick on that.
Look, this business has been very good to me and my family. I've had a very blessed career. I've been able to, do pretty well. I've been able to be part of running and building and expanding a number of companies with a ton of great people. So that's very gratifying because, a lot of people I've worked with over the years, I'm still friends with today, from 35 years ago. I mean, those are great relationships and friendships that you'll have until you get out of the business, and you'll have them even after that, right? So look, my advice, let's just focus on building or rebuilding a business, which I've done the last 3 shops that I've been at, over the last, call it 15 years. You got to hire right? You got to hire people that have the right mindset, the right skill sets, that they're accretive to your business and can help you get to the next level. But you've got to create the right culture, and that again gets back to people. So to me, it's hiring right. That's where it starts, and then instituting and keeping going as you expand those businesses. Keep that culture that you had when you were small as you get bigger. I was fortunate in the shop that I was at prior to joining Red Oak, Money 360. I mean, we took that platform from really nothing. I mean, I would think I was employee 6 or 7, and we grew that platform from about $20 million in volume when I got there. 5 years later, pre-COVID, we were up to 39 employees, and we'd done over $1.8 billion of funded loans, and had 850 million of AUM, I think. So, but we couldn't have done that without hiring the right people in their various roles, whether they were originators, whether they were underwriters, whether they were processors or closers or capital markets people or asset management people, right? We made the decision early on that we wanted to hire just experienced people, that it was nobody's first rodeo. Now, that said, we did hire junior people that were able to work their way up through the business and learn the business like I was fortunate to do under somebody else's tutelage. But I think these businesses, you got to have a good business plan, but you're not going to be able to implement that business plan successfully, Dustin, without the right people. And so it's incumbent upon whoever it is in whatever business you're in, whether it's the commercial real estate lending space, mortgage banking space, residential space, et cetera. Hire the right people for the right role, and you will be successful. So long as you can keep the culture in place, and that's the challenge as you get bigger and bigger. Is keeping that culture in place. But I've been really lucky. Again, I've hired great people. I've worked with great people. I'm still friends with a lot of the guys that I worked with, early in my career. And so, those relationships are invaluable as you build businesses and expand businesses, because you can pick up the phone and either get somebody to help you or come to work for you or be on your board or, whatever. But it's a people business. You know, it always has been, it always will be. I mean, when I got into the business, somebody helped me, right, and helped me along, and that's kind of where I'm at now as I get to the later part of my career, is to try to give back to both the employees that we hire that are typically younger than me, and the new people that are trying to get into the business, and you help them through, like I was helped through, you know, when I was, you know, a year or two in the business. So people is the short answer to your question.
Yeah, well, and you talk about culture there. I mean, and it's, you know, I'm curious to know. I mean, obviously, you've mentioned a couple of times, you know, the amount of travel you've done this year, but I'm assuming the rest of the company has not done the same amount of travel. How have you kept that culture together during this pandemic? I mean, what, you know, any strategies or success stories you've got?
Yeah, great question. No, you know, it is challenging. It is challenging not being in the same office with people. I mean, we've got, you know, whether it's our production people or our back office people, you know, they're spread out all over the place. Now we are in the process of opening another office. This week I'm in beautiful Grand Rapids, Michigan, with snow outside, because this is our corporate office, and this is where we started, and we've got a back office here. Now we're in the process of opening an office and staffing it in Southern California and in the Irvine Spectrum, to provide additional processing and origination capabilities as we expand the Red Oak platform. But you know, I kind of lost my train of thought. Sorry about that. What was the question again?
So yeah, the culture during the pandemic. How have you guys, you know, have you guys kept it together? Not being in the same space?
Yeah, you know, it's a lot of Zoom calls, right? It's a lot on the phone. But you know, again, I think that gets back to the people, right? If you've got good people and you don't have to hold a lot of people's hand, which is, you know, one of the advantages of hiring experienced people, you don't have to, you know, worry about, you know, riding herd on somebody to get their work done. But look, it's a lot easier when we're able to be together. And that's why I do so much traveling, whether I'm visiting our Grand Rapids office, whether I'm on the road with our origination personnel on the origination side of the business, at least, you know, those companies that we could interact with, that don't have restrictions on their employees interacting with outside parties, you know, or whether it's the capital market side of our business, you know, interacting with the people that we raise capital from all over the country. It is difficult, and you can only do so much in Zoom because, again, it's a people business. You want to be in front of people, you want to interact with people, and you really, it's more difficult to do that on a Zoom call or a WebEx call or what have you than it is in person. So it is harder to maintain that culture. It is harder to maintain those relationships remotely. But again, I think that gets back to the people that you hire and knowing, you know, who you're dealing with and what they're made of, right? And we'll get back to being together soon.
Yeah, no, that makes sense. All right, so
most of our workforce is remote currently, whether they're on the origination side or the underwriting side. So most of those guys are remote, and I think, you know, we'll still allow them to work remote based on how comfortable they are being back in an office environment. You know, we're not going to force anything down anybody's throat. You know, my thing is, as long as you get your work done, as long as we're continuing to be productive, which we are, feel free to work remote. We had the same strategy at Money 360, by the way, when COVID hit, and I was still there. We allowed people to work remote, and then when we reopened the office, we give them the election of, you can either come in or you can continue to work remote, so long as the work is getting done. And I think that's the right strategy. Again, these are unprecedented times that we've all lived through the last year. So I think you need to be cognizant of that with your employees. But if you've hired the right people, they're going to get their work done, whether they're working in an office or whether they're working remote.
Yeah, I think a lot of C-suite folks are going to take that same approach once the restrictions lift. I don't think there's going to be a mad rush for everyone to come back in the office. So I don't think you can. I think you're going to have to stage people in. Again, you're going to have to stage people in for a bunch of different reasons, but I think the biggest is to get them comfortable and to break down and change those behaviors that everybody's been conditioned upon over the last 12 months. Yeah, no, I agree. All right, so we've got time for one last question here, and you know, I think this is a good one to tee up for you. Why, talk for a minute about advocacy and the importance of advocacy, and why, especially, folks on the commercial side of the business should care about the advocacy work that groups like the California MBA and the MBA nationally take part in.
Look, if COVID has proved anything, right, it has proved that governmental action on governmental, legislation can have a dramatic impact on a business or a sector of the business, right? And so, again, I've been part of California mortgage bankers almost since I got into this business. So it's always been, something that I've participated in and found great benefit in being involved in, which is, why I'm on the board, why I'm the chairman of the Western States Conference. But the mortgage banking community needs advocacy, right? We need representation in Sacramento, for example. And because there's a lot of bills that are either proposed or trying to be passed, they're going to have a detrimental effect on our business, whether it's on the residential side or the commercial side. So without that advocacy, without Susan and everybody involved in California mortgage bankers, fighting for us, they could pass legislation that could dramatically impact our business and have to a certain degree. I mean, there's been some things that I know California mortgage bankers has been successful in getting stopped that would have had a dramatic impact on the commercial real estate space, residential as well, but I'll have to speak specifically to commercial. And without that involvement, without the you guys up in Sacramento, pounding away at the legislators to get some of this stuff stopped, or at least get the language softened slightly, it could have really had a detrimental impact on the commercial real estate business in a number of different ways, whether that was for whether that was for retail or the restaurant industry or other sectors. So, without, having that advocacy, without having those people walking the halls of Sacramento and pleading our case and telling these guys why this is a bad idea, have you really thought this thing through, which clearly in a lot of cases they hadn't thought it through. They were reacting like politicians are prone to do, unfortunately. It could have a detrimental impact on our business. So, I mean, that's why we're a proponent, we're a member, we're active, I'm active. And I think others, if they're not involved, they absolutely should be involved, because you have to look at the long-term picture here, right? I mean, I've been in the business 35 years. It's been a great run. But look, the guys that just are getting into the business now, we have to make sure that they can be in the business for as long as I've been fortunate enough to be in this business and have the success without, that industry being changed fundamentally by some governmental action that really wasn't thought through all the way.
Right. No, I agree. Well, and if you're interested in membership, certainly you can reach out to myself here or check out our membership page on our website for more details and information on that. Well, Gary,
call me and
call Gary. Exactly, he'll tell you.
I'll give you my take on it as well, because it's been great, and it's been great to be involved, and I continue to look forward to being involved. And if anybody has any questions, feel free to reach out to me as well. Happy to help, Dustin.
Yeah. Well, we do appreciate your support, Gary, for sure. Well, and thanks for joining us on the podcast today. It was really good to catch up and talk through what's going on in the industry today.
You as well. Thanks again for the opportunity, and look forward to seeing you soon in person.
In person, absolutely. So yeah, if you enjoyed the conversation here, make sure and you can subscribe to us on our YouTube channel here, or you can follow us on SoundCloud, Spotify, Apple Podcasts. We're in all those platforms as well. And we'll be back again next Monday for another episode of Connect. We'll see you then.